Now, all that being said, I want to start off with just reviewing some of our recently posted content and what we have here, the last 4 presentations we had, using the long option finder on PowerOptions and historical options data to better analyze or refute an extreme case or an extreme claim of a return or a potential trade. Preferred married put criteria discussion. Where's the mention of the Greeks? We had a question come in saying, hey, I've been going through the blueprint, but I don't hear you talk about delta or gamma or theta or implied volatility. And we review why you don't necessarily need those when you're using the proper and preferred search and criteria. It's already taken into account by looking at the preferred maximum risk and the preferred structure. And earlier today, we posted our conversations from Johan, a long call versus a married put. Are it actually a parity trade of one another? Not really, but we go through why, and we go through why we prefer the married put structure to just buying a leap call, for example. And that led to another discussion on an in-the-money long strangle, buying an in-the-money call and buying an in-the-money put that you might use for the married put position as opposed to the married put structure, and why that's not the same strategy, and you have a different expectations and different goals. Those are all available on the YouTube channel. You can check those out at any time. Just go to YouTube, find PowerOptions, and click on the videos link, or click on the playlist to see a variety of different discussions for the different strategies that are out there. 7 to 8 videos for each of the strategies, talking about criteria, structure, management techniques, and much, much more. Now, a new tool here that we have for Scott's second question, but also a very easy tool that's existed for a while. Scott's follow-up, how can I find stocks with earnings within the next 1 to 2 weeks? Well, we added a new pod here that has some other features. Earnings announced today, for example, that's the one we want to take a look at. We've had that for a long time. Let me see, is there something? And then there's unusual option volume is one of the newer ones that we've added also. But here, earnings announced today, I want to say, okay, well, these are coming up soon, but let me click on View Upcoming Earnings. And what this tool shows you is the earnings coming up. Here's one for 2/24. Some others for 2/24, Deere, Sorrento, Walmart. Toll Brothers, don't expect a big move in Walmart. Home Depot's coming up on 2/24. Shows you if it's been confirmed or not before or after market. And what is all this other data here? Well, it's showing you sort of a strangle or straddle position, excuse me. And so it's looking at the expiration date of this. I'm sorry, I apologize. I read that wrong. The earnings date is the 7th, that's today. So the 20th ones, the ones coming out on the 20th. 21st. Okay, so you can't trade on the 20th. That's weird. I don't think that's accurate. I think they're going to be the 21st before market. I apologize. In any case, earnings date's there. Expiration date of a straddle, and here's just a straddle idea using the 317.50 strike for the 2/24 expiration for Home Depot. It's coming out on 2/21. Is it a guaranteed position? Is this a position that you should expect a profit on? Not necessarily. You're still going to need the stock to move significantly because it's going to be inflated, but you'd want to build that in the profit and loss chart and see where it is. But most importantly, if you're doing a search, you're doing a strangle search, for example. I thought I had added in here. I did not. Let's go ahead and add in, let me take out long collar for the time being. Let's add in long strangle. There we go. Perfect. So in the search tool for any strategy, when you go into the fundamentals section, you can screen specifically for stocks that do have an earnings date between now and the expiration. Stocks that have earnings between now and 2 weeks from now, or sometimes you might see between now and blank to blank days. You could put in 8 to 14 days, set 5 to 15 days, however you wanted to do it. Or not between now and expiration, which I always use for the things such as credit spreads and other income generating strategies. But yeah, just make a subtle change here, plug that in, and there we go. So we've got the positions here with earnings coming up in the next 3 to 4 days or so. And so this question mark here is, I think these are errant. They're not really confirmed. BHP is not really confirmed as we saw because the market's not open. They're probably going to be on 2/21 at some time. But you see some other ones that are here for 2/22. And you can filter that too in different ways. You could filter by the earnings date, expiration date, however you wanted to do it. But that's all in the fundamentals there. There's different forms of using that earnings date between now and expiration. Or you can just use the earnings date pods if you wanted to see a manual one of those views. Okay, so that's going to wrap that up there for Scott's questions. Moving on to Anthony real quick. Anthony was talking about doing the new covered call ETFs that are optionable. And these covered call ETFs pay a monthly dividend. So the idea is to track the covered call, I guess at the money premium, I'm not sure, on the stocks in the S&P 500, NASDAQ 100, Russell 2000, and Dow Jones, for example, as well. Would it make sense to sell covered calls on those to enhance return or use the wheel strategy? Well, first off, what are the symbols for these? Well, I'm going to use Lookup there at the top. And we can just do a quick search for covered. And that will cover us for the search. So here we go. We've got QYLD. That is the NASDAQ 100. RYLD is the Russell yield. That's what it stands for, but that's the Russell 2000. XYLD is the Global X S&P 500. And DGIA is for the Dow 30, covered call ETF. Okay. So let's take a look at what we've got. And the fastest way, if I'm interested in doing a covered call, in my opinion, what I should say, the fastest way for me to analyze a covered call return possibility, in my opinion, is just to use the PowerOptions chain. And the reason why I want to use the option chain is because on the PowerOptions chain, we show you the percent return and the, the percent return if assigned, percent downside protection if you entered it as a covered call today with current prices. So let's take our first one, RYLD. No, let's use QYLD, I apologize. QYLD. Okay. All right, well, February 17th doesn't do us any good. And unfortunately, these don't have weeklies, so we've got to deal with the monthlies. Let's go 30 days out in time. At the money, reasonable covered call. Might expect a 1.5% return in premium or so, maybe 2%. And the stock's at 1668. The 16 strike is offering a 0.1% time premium. Let me find the time value here. Yeah, ask time value. Wanted the bid time value, but that's okay. Oh, I just wanted puts. I'm sorry. No, I wanted calls. I'm sorry, folks. I'll get with it in a second. Fantastic. All right. Time value midpoint. In the money, 0.1%. 60, 70 cents at midpoint, so 2 cents profit. Out of the money, 17 strike, 5 cent bid, 8 cent midpoint, 10 cent ask, 0.5% time premium for 30 days. Really, really low. Why? IV, 0.122. Good open interest here on this position and some good current volume, but that's just at the money. Everything else is not showing a lot of activity at all. You can see why. There's just no point. There's no premium. You're going to be right at the money to get anything. Well, as volatile as the NASDAQ has been and tech has been, maybe RYLD, looking at the Russell 2000, stop hitting K, Mike, will be better. Going to March, minus 0.2% midpoint time value. It's below intrinsic. The midpoint's at 48 cents for the 19 strike, and the stock's trading at 19.50. The midpoint is below intrinsic. The 20 strike, close to at the money. They're equidistant, of course, only a 0.1% time value. Is that worth it for a covered call or selling a put against it? The put's going to be the same. Activity, okay, 428 open interest, but not much going on away from the at the money. Was our SPY one. That was the XYLD. And you know we're going to see the same exact thing. 4101, perfect. And a right at the money strike. 28 days out in time, 0.2% time value. Here's one that's a 0.9% time value. That looks pretty good for an out of the money, but it has a zero bid, a 70-cent ask that's not getting filled, one open interest. You're not getting 35 cents for this option. You're getting 4 or 5 cents, let's be honest. Okay? That's why there's no activity on it. So I don't think it makes sense, Anthony. I don't think the premiums here are going to really enhance that monthly dividend payment that you would see. I think there are better opportunities out there than trying to do a covered call strategy on these covered call ETFs that have low activity, very low premiums. I'm not expecting these premiums to increase at any time with such low implied volatility for these securities. Monthly dividend, great. Could you augment it by maybe 3 or 4 cents? That seems to be the common for the just slightly at or just slightly out of the money. If you're doing a big enough position, you feel those 3 or 4 cents will help you return over the year with the dividends, perhaps. But I don't think this is going to hit your target goals, is what I'm saying. We're doing a wheel strategy. It just doesn't have the oomph, doesn't have the implied volatility, doesn't seem to have the interest in those cases. But again, if you want to look up something like that, you don't know the symbol, use that lookup field and just type in your word, oil, gas, natural, covered, and then you can submit that and see the different ones, and you can find your listing very quickly. And then you can link to the option chain as we did and evaluate, hey, is this even worth it for me?